If you're selling options, winning most of your trades, and still feel like your account isn't growing, or worse, keeps taking sudden hits, this video is for you. Because selling options does work. But for most people, it's not working the way that they think it is. Today, I'm gonna break down the 3 biggest mistakes that are silently killing option sellers. And then I'm gonna show you one structured fix that actually makes selling options super sustainable. And near the end of this video, I'm gonna call out 2 things that I constantly hear people bragging about: rolling covered calls and rolling puts. Strategies that might sound smart, get repeated everywhere, and in my opinion, completely miss the point of selling options. So stay till the end, because if you're selling puts or covered calls, this will probably change how you're currently trading. Hey there, if you don't know me, I'm Michelle, and I have been trading for nearly 30 years. I've sold options professionally, and I've blown up accounts. And not because selling options doesn't work, but because I misunderstood how risk actually shows up when you're selling options. Now I'm here to share those challenges with you so I can show you exactly how I overcame them so you don't have to suffer the same way. Now the first mistake is thinking that a high win rate means that you're doing well. Selling options feels amazing because you win a lot, 80%, 90%, sometimes more. But selling options is asymmetric risk, and here's what I mean by that. You collect small wins repeatedly, over and over. And one loss can erase months of progress. So you don't have to be trading badly. You're just misunderstanding the downside. That's why it's so important that you focus on realized gains and minimizing or eliminating realized losses. That is probably the most overlooked thing that traders do. And all you need to do to combat that is just keep a spreadsheet of your realized gains, week to week, month to month. The second mistake I see people make is treating assignment like something that's not going to happen. Assignment is not the problem. Unplanned assignment is the problem. If you sell a $100 put, you're taking on $10,000 of exposure. You have to understand that. You're committing to buy 100 shares if the stock drops below $100. And most people don't model what happens after assignment. That's where the real damage starts. You have to model that before you put the trade in. What happens if the stock drops 30%? Do you have enough money to sell another put and buy more shares if the stock goes down? Is it a stock that you actually like that you're okay buying? Which leads me to the third mistake people make, which is sizing their trades. You need to size your trades based on how much damage one position can do. What I mean by that is you need to have money on the side to buy more shares if the price goes down. You will not be successful if you don't do this. You see, it's not that option sellers run out of ideas. There's ideas all over the place. They run out of buying power. They run out of margin. They run out of capital. And so many traders know their maximum profit, but they never work through their worst realistic scenario. Now, I want to talk about something that I hear way too often. I hear it here on my channel, and I hear it all over the place, actually. And I genuinely do not understand why this keeps getting repeated. People love to talk about rolling their options. I don't know why it feels so good to them. I'm going to go through 2 scenarios, and I'm going to tell you why this is most likely the worst mistake you will ever make trading. And you might be making money now, perhaps this week, this month, maybe even this year, but you will not stay in the game long with strategies like this. You just won't. And for some reason, these are things that successful people don't tell you, but I'm going to share them here with you. Let's go through scenario number 1, the one that makes me cringe the most. Rolling your covered call. You own 100 shares of stock. Your cost basis is $100. And you sell a covered call with a strike price of 105. Now, all day long, that is a winning trade. Why? Because you're paid a premium that you keep no matter what happens. If the stock goes higher, you sell your shares at a profit. If it doesn't go higher, you keep your shares and you get to sell another call next week if you want to. There's no way in this scenario do you lose money because you already have the risk on the stock. This is a winning trade. Covered calls are the most conservative strategy that you can use. Now, let's say the stock rips to 125. Suddenly, you feel bad. Not because you're losing money, but because you feel like you're missing out. It's like FOMO nonsense. Fear of missing out. So what do? You buy back your call and you lose money when you do that because you pay more than what you originally received in premium. Then you sell another call with a higher strike price further out and take in more premium, and you think you're clever because you netted a gain. You are not clever. That is the dumbest mistake anybody can make trading options, bar none. You literally just turned a profitable trade into a realized loss because you're greedy and you don't even realize that you did that. And what's worse is most of the time, you guys don't even realize that you actually took a realized loss on that trade because you're just seeing the net gain. Bro, nothing went wrong on that trade. That trade went exactly as it's supposed to. You made money. The purpose of selling options is not to capture unlimited upside. It's to create guaranteed income. And you did that. That is a surefire way to, at some point, turn a winner into a loser. And that's a losing strategy. That is, again, the dumbest thing I hear people do. Now let's go on to the second dumbest thing. I hear way too often people talking about rolling their puts. And in most cases, that's not smart either. The entire foundation of selling a put starts with this basic premise. You chose the right ticker. You chose a stock that you believe in, that you would be okay buying at that strike price. Now, if the stock goes down, it's an okay thing because you're buying the stock that you like at the price that you already thought that you wanted to pay for it. Why are you now having second thoughts? Having second thoughts means you didn't think through the trade enough at the beginning. So you buy your put back, pay more than what you originally received in premium, and then sell another put with a lower strike price further out. That's dumb idea number 2. Here is a fact that you guys forget about stocks. They go up and they go down, all of them. And over the long term, good quality stocks go up. So you're supposed to pick a good quality stock when you're selling a put on it. And you're supposed to keep cash on the side, so if that stock goes down, you get to buy more shares of that amazing company at a discount. Oh my gosh, newsflash. So when the stock drops, that's not your strategy failing. That's actually when your strategy is working. Now the correct response is not to panic and to go roll that put. Don't do that. Again, you're turning a paper loss into a realized loss. And the most important thing when it comes to trading options for income is creating realized gains and minimizing realized losses. When you sell options for income, you have such high probabilities on your side that you're constantly making like 80%, 90%, singles. You don't want to have that one big loss where you're taking a realized loss that affects all your income. You don't do that. Again, you might think it's okay, like for 1 week, 1 month, maybe you get lucky. Hey, if I had a broken watch and the battery was dead, it would still give me the right time twice a day. This is the same thing. So instead of rolling your put, take the shares, sell a covered call on those on Monday. And then if the stock drops even more, sell another put, take in more income, and if you get assigned those shares, you're averaging your cost down. That is how successful people make money long term. And if you don't want to own the stock at a lower price, you should not have sold that put in the first place. Now I know that this conversation is what creates a little bit of drama because lots of you viewers talk a lot about rolling your options. I think because you hear that nonsense on the Tasty Network or Option Alpha or some of these other, dare I say, goofy platforms that suggest that that's a good idea. If it works for you, tell me why you think it works for you in the comments section. And I don't want to hear that you're netting a realized gain, because if you keep track of your realized gains and your realized losses over time, you are absolutely creating a realized loss buying back your contract. Now, that's not to say that I never close a position, because I do close positions very often. So I want you guys to hear me loud and clear. For example, when I sell a put and I capture most of the premium in that contract, I will often buy that contract back, give a little bit back to the market, and sell another put on that same ticker. Maybe the same strike price, different date, maybe a different strike price. But the main difference is I'm locking in a gain and then I'm selling another contract. So please understand what that distinction is. Also, sometimes I have shares where I'm long and I sold a covered call against those shares. And sometimes I will buy back my call and sell my shares right then and net an overall gain. And the reason I do that is to remove the risk, to lock in the gain and then remove the risk on that contract. But I will never buy back a contract, take a realized loss, and then sell a new contract on that same ticker with a different strike price and or different expiration date. I think the only people that do that are people that do not understand options trading. And I know that that might be hard to hear, but it's still a fact. Now, here's the structural fix that ties everything together. And you must ask yourself, especially when you sell a put, what do I do if I'm assigned those shares and the stock price keeps falling? If you can't answer those questions, you're not trading, you're gambling, and you're hoping. And that is not a strategy. Now, selling options works. I'm a real live example of that, but you need to get rid of your emotion. And it is important to focus on probabilities because you do need that in option selling, but you also need to prepare. This isn't about making money for 1 week, 1 month, or 1 year. This is about making money for the whole rest of your life in a consistent, sustained way. It's about staying in the game forever. Anyway, I hope this video helped. If it did, smash the like button. Subscribe to the channel and tell me if you do roll your options, why you think that's a good decision, especially after listening to this video. There are lots of ways to make money in the market, and there are lots of ideas that are really good, not just my strategies. But rolling options in these two scenarios that I explained in this video are just two of the worst decisions I see people make over and over again. Now, if you're new to trading, or if you've been trading for a while but you're not getting the results that you want, consider joining my group in February. It's a small group of only 20 people, and we go live 3 days a week to not just help you put your trades together, but monitor them and manage them for an entire month. It's a really great opportunity. The details are in the comment section below. Anyway, happy trading.